Real estate rules. You can't ignore 2%, 50%, and 70%. Welcome back to the Real Estate Podcast, where we simplify creative real estate investing and give you practical tools you can apply today. In this episode, we're diving into the essential real estate investing rules of thumb that can help you make faster, smarter decisions. The 2% rule, the 50% rule, and the 70% rule. Before we get into formulas, let me be clear. These are guidelines, not gospel. You should always run a full analysis before investing, but these rules will save you hours by helping you filter deals quickly. The 2% rule or 1% rule. This rule gives you a fast gut check on whether a rental property might generate strong cash flow. It works like this: monthly rent divided by purchase price equals percentage. So if the property rents for $1,500 a month and costs $100,000, you're at 1.5%. That's promising. If it rents for $1,000 and costs $150,000, that's only 0.67% and likely not cash flow positive. Personally, if a deal is under 1%, I pause. Between 1 and 2%, I investigate. Over 2%, I act fast. Those deals are rare today. The 50% rule. This rule helps you estimate how much of your rental income will go toward operating expenses. Things like taxes, insurance, maintenance, and vacancy, but not your mortgage. Operating expenses, approximately 50% of gross rent. If you're collecting $2,000 in rent, assume $1,000 will go to expenses. That leaves $1,000 to cover your mortgage and hopefully profit. If your mortgage is $800, that's a $200 monthly cash flow. It's not exact, markets vary. But this rule reminds us that owning rental property isn't just collecting rent. You need to budget for real costs that creep in over time, like roofs, HVACs, or tenant turnover. The 70% rule. Now, let's talk flips. This rule helps you avoid overpaying for a property you plan to renovate and resell. It goes like this: max purchase price equals 70% of after repair value, ARV, minus repair costs. Let's say a home's ARV is $300,000 and it needs $50,000 in work. 70% of $300,000 is $210,000. Subtract $50,000 in repairs and you shouldn't pay more than $160,000. This rule builds in room for closing costs, holding costs, and most importantly, your profit. But heads up, in hot markets or low-value homes, this rule doesn't always hold. You might need to adjust to 75% or even 80% in some cases. The key is knowing your numbers. Final thoughts. These rules of thumb aren't meant to replace due diligence. They're meant to help you narrow the field. Use them as a first filter, then dive deeper on deals that pass the test. Next time you're looking at a property, ask, does it pass the 1% or 2% test? Does the 50% rule leave enough room after expenses? If it's a flip, does the 70% rule make sense in this market? On the next episode, we'll break down how to actually find off-market deals that meet these criteria. Until then, stay sharp, stay creative, and go make that next deal happen.